All right, welcome everyone. Welcome to the Hurley Investments Market View Commentary, starting on January 8th of 2024. All right, I'm going to do a couple changes this year. And what I'm going to try to do is for the first, the first 10 to 15 minutes, I want to start lessons. And I hope by the end of the year, I've got these 44 lessons all prepared and all ready. And these lessons will be on my YouTube page. So these 7 to 15 minute lessons on the stock market can be viewed by anyone all the time. And that way I can start with just, hey, let's go over something that'll help you in the stock market, whether you're with me 2 years from now or not. And my lesson today was going to be on valuations. And in all essence, this equals the way that we do things, the Warren Buffett stock evaluation. So a lot of times you've heard us say, hey, we use the Warren Buffett's valuation method to decide what kind of stocks we're in, if we like them, how we value those stocks as a stock that has an opportunity for the year. You'll hear valuations said throughout all of the, you hear valuations thrown out there a lot. And quoting Warren Buffett, I should have put it this way. If you don't know what you are doing or how to work the numbers, diversify in an index. And that's good old Warren Buffett, and I'll get the better one for you in there. But what he's trying to say is if you don't know what you're doing, you go to a mutual fund, you go to an index, you go to an ETF. He suggests you stay away from ETFs and indexes because of the cost involved with them. But he does want you to be in an index of some kind if you can't calculate the numbers. So today I'm going to show you a lot of my work that I've done. And at the end of this, I'm going to close this down and I will attach it as a handout so you guys can use this or grab it at your convenience. But I'm going to give you a spreadsheet. I've done this on hundreds, but we're just going to go over a couple today that are the core holdings of Hurley Investments and why. And I'm going to work with you for the next 20 minutes on finding valuations for companies, what we see and what we've used. I really love Rich Warman. A couple times he said, man, it's amazing. You told me that JP Morgan would go to 170 to 175. And I was like, yep. And I was kind of a week late. But yes, I told you that, and here's how it got there. You told us Apple would go to 200, then it'd probably back off. It did that. I love it. He once told me, how did you know Bank of America would get to 55? And I'm going to show you how I've done it using this simple spreadsheet. And I will upload this spreadsheet so that you guys can download it and grab it yourself and be able to use it yourself as you're looking at some of your own stock positions in your portfolio. But all of my information I've picked up from FinViz. So the information I've gathered for this is right here on FinViz. It's off of the second PE and forward PE, current earnings per share next year. That is where I'm gathering this information, and I'm dating it for today. This information is always changing, but this is my next 12-month expectation or look into the future. If you can see, as we start with the symbol on column A, PE, which is a current price to earnings ratio, the forward PE, what they think it's going to be in the next 12 months. I then put in here the PE that I use to calculate my price. Earnings per share next year. The earnings per share I used to calculate my target price. If you look at my target low, on the low end, how low can Apple get to if it has a really bad year, if there's something that's wrong? I came up with 157. And all I did is I took the lowest PE, whether it's a current or a forward, by the lowest earnings per share. So in this case, I took the forward P of 25.75, multiplied it by the current earnings per share of 6.13. I came up with $157.85. Technically, I should be using a target low of the forward PE to the future earnings per share. But a lot of people talk about using, hey, wouldn't you use your current PE with your current earnings per share? Well, that just gives us our stock price. If we use the current PE and multiply that by the current earnings per share, that should be our stock price. Now, our stock price is a little bit higher because this is a day old. Some things haven't changed, but Apple finished at $185.56 today. Where I'm going for my target low, I'm taking the lowest PE, which is the forward PE, multiplying it by the lowest earnings per share, and that's the range that I have for a target low for the year and a target high. Target high is nothing more than the forward PE. Actually, it's the current PE times the highest earnings per share. Gives me the 212.96. Well, Kevin, that's a big range. And my answer is no kidding. But this is where you have to run your mathematics and where you have to run your own common sense on deciding where you want to judge each individual stock and what you believe. And Rich, I just saw Rich Warren jumped in here. This is where I can surprise Rich, and on a couple times he'll tell me, how did you know that it was going to get there? Well, the numbers tell you that it's going to get there. What they don't tell you is news that could come in that could detract that, wars, economic events. We don't know what can sidetrack it, but I can work the numbers and tell you, hey, this is exactly where it should be. So let me go through a half a dozen with these with you today to give you an idea how I've come up with the pricing for some of our individual stocks. I'm going to start with Apple. Apple has a current P of 29.91 and a forward P of 25.75. To me, that is low. Kevin, why do you think it's low? What's your rationalization behind that? Well, Google's a 26.25 to a 20.5. Okay, Apple seems to be a little bit better than Google. Intel forward PE is a 25.48 right here. Well, that seems a little more in line. Current for Meta's 31, looking to be 20. Kevin, it seems like it's okay where it's at. What else did I put in here? I put Netflix 47 to a 24.78. Amazon 77 to a 40. I'm trying to find like stocks that come into this position. And for Apple, Apple usually runs on average a 28 to a 30 PE. Apple's PE this year, up to this point or as of today, is a 29.91. So people think going into next year, Apple's price to earnings is going to come down. It's a little interesting because if you look at next year's earnings expectations, analysts come in at a $7.12 price label. But if you know anything about Apple, they usually miss by $1 to $1.50. Their own projections are less than expected, and there are no projections except for growth rates going into next year. For Apple, I use their standard 30 PE. I use their earnings per share where they normally beat by $1 to $1.50. I'm giving them an extra dollar. That gives me a target price for Apple sometime next year of $243.60. That is how I'm coming up with price targets for Apple and where they can be. I'm doing the same thing that Warren Buffett does so that I can just give myself a general idea of where things are going to be. Bank of America. Bank of America's price closed today, and it's got to be $34 and change. Let me get it really quickly. Bank of America closed today at $34.16. If I was to give you some background on Bank of America, its highs, the 5-year high is $50.11. And that was back on February 10th of 2022. Currently trading at $34.16. Where would Bank of America go in the future? Its PE sits at $9.44. Its forward PE sits at $10.36. So into a decreasing interest rate environment, Bank of America is expected to make more money. Can anyone explain that to me? Why might Bank of America make more money in a decreasing interest rate when it should make more money in an increasing interest rate? Anyone know? Why is it projected right now that Bank of America can make more money into the future on a decreasing interest rate rather than an increasing interest rate? Kind of a trick question, but I like some of the answers that are coming in. More borrowers. On a less of a rate, they can borrow more because people think they're getting a deal. I love that. Market discount rate. It'll make mortgages cheaper for people. They'll make less money, but they'll have more volume. I like that one. People who have debit with Bank of America will be able to pay it easier. Correct, but that doesn't make more money for Bank of America. That is correct, but that doesn't help them with their price to earnings. As I was choosing a PE for Bank of America, the biggest point is if the rates come down, all these bonds that they have that are I don't want to say worthless, but you can't trade them. There's no market for the bonds that they currently own. They have hundreds of billions of bonds that they blew it and didn't roll it forward. So a lower interest rate, a couple rate cuts coming in will increase their book and give them more money to be able to borrow out against it. As I looked for some of the other banks, Citibank was 8.57 to 9. Key Corp was 11.92 to 11.5. Goldman Sachs is 18 to 11. Morgan Stanley is 16 to 14. What PE would you use for Bank of America? What PE would you use for Bank of America? Throw some numbers out. I just showed you some of their competitors. C Corp, 11.49 in the future. Wells Fargo has a 10.19, and they're screwed. Goldman Sachs, 11.33. Key Corp, 11.49. Morgan Stanley, 14.25. Throw me a couple numbers. What PE would you use for Bank of America? Maud says 11. That's a fair number. Anyone else? I mean, you got Bank of America right now at 10.36 with Wells Fargo floundering in their mortgages. Bank of America only has like 20%, 24% of their business in mortgages. What would you give them for a forward PE for next year? 14.25. You want to match Morgan Stanley, huh? They do a little bit different. What PE would you give them? Abraham, what about you? Rich, what forward PE would you give them? Jim Kohler says 12. So as I looked at it, I would think that we would have 2 rate cuts. And the rate cuts, if I'm going on the low side, are a 1/4 point, 2 1/4 point rate cuts. If we have 3, it's going to be even better. But if we have 2 rate cuts equal to about a little more than double of an opportunity for an earnings for them. So I was coming up with an 11.50. 11.55 actually. Don't know how I came up with that exactly. So if I use an 11.55 times their next year's projected earnings, I come up with a price of $37.54. That would be a realistic price. If we're going to change this and go to 3 rate cuts, that gives them a PE of a 12.25, which gets them up to $39.81. That would be a realistic target price for Bank of America. I'm going to do Baidu. Baidu, because I like it, has a 12.86 to a 10.78. A realistic average return on Baidu puts a forward PE of 22, and that's less than their 25. If I was to take their 22 PE and multiply it by next year's earnings, that gets me at 234.26. And if I went on the high side where they're at 28, it gives me a 303.24. But I'm trying to be realistic and go on the low side. We've already done Disney. Disney has a P of 70.96 right now. That doesn't work. That is a ridiculous PE for Disney. Those numbers don't add up. 17.34 forward PE, because the numbers are skewed right now. That also doesn't add up because they're normally in a 25 to 27, 28 PE. Part of their PE is based on parks. Six Flags Magic Mountain has a 26.71 current PE. Comcast has a current 12.04. Wonder what Netflix is at. I put Netflix in here. Where's Netflix at? Netflix has a current PE of 47.86, forward to 24.78. As Keith and I were working, Disney, what they have coming up, their movies, their parks, their Disney Plus, we came up with a realistic expectation for a PE to be 30. If you multiply that times the price per earnings in the future of 526, we have a realistic price, target price for Disney at $157.80. If we did Ford, because someone already asked about Ford, General Motors has a 5.13 to 4.7 future PE. Tesla has a 76.76 to 63.26 PE, which is outrageous for not even a 500,000 cars delivered this year, right? And Rivian doesn't have any PEs. They're so in trouble and going to go bankrupt, we don't even have a PE for them. Ford. If I was looking at a target price for Ford, I would think they'd be somewhere between 7.8 to 6.64. I would give them a 7. Future earnings per share is $1.79. A realistic price for Ford is $12.53. Ford closed today at $11.97. Why did we get out of Ford? We got out of Ford because until they stop blowing $3 to $4.5 billion a year on electric cars that they suck at, their earnings will remain low. They're working on it. If sometime next year they say, hey, we're done with electric, we're not spending any more money on it, you could see a realistic next year PE of be double that, which would be about $3.50, which would change numbers for Ford back up to $24.50. But right now, they are not offering that opportunity. And their earnings per share and the money's still spent on electric, gives them that PE. Have they changed that though? They've lowered it significantly. They did spend as much as $7.5 billion. Doing more hybrids, still involved in a hybrid, still has a large amount of initial investment. If they stop spending that kind of money and cancel that program for electrics and just go to hybrids, yes, you could see their earnings per share change. They'd be a $24.50 stock. They're not there yet. All right. Meta. Move it to the top. Kevin, Meta's already higher, 358.66. It is already higher than the upper end price range for the market. Yes, that's why it's had a really, really, really hard time getting above 360. It's been there a bunch of times. Comes up, comes back down. Current PE is 31.18. Future PE is 19.96. If I was looking at a PE for them realistically, it's somewhere in the middle. And they can keep their 31.18 if they will stop wasting all that money in the virtual world garbage. But if they changed and we're in the middle, a realistic expectation for the future would be $459.94. That's where Facebook or Meta would be in the next 12 months. Pfizer, a lot of people said, Kevin, why are you getting out of Pfizer? Yeah, they lost a couple of their opportunities. They lost their patent for a couple of their drugs. They finished today at 29.58. I should have used some of these numbers on last Friday. But current PE, is it going to be 12.72 or less? If you're to ask me, taking out some of their patents that they're losing, they're probably closer to a 10.75 on their PE. I still like their earnings getting to $2.31 because I don't think they can get much higher than that. That gives them a price target for this coming year of $24.83. That is why we didn't pursue Pfizer and look to use it or go into the near future looking at Pfizer as an opportunity. Micron. I really love where Micron can go. We've got price targets of over $100. Micron does not have a current PE. There's a problem with Micron right now. Government interference. They do have a future PE of 12.96. Earnings this year were 6.28 to the negative. They're expected to be at 6.57 next year, making money. So they had a negative year of earnings this past year, expected to be making up last year's gains. Is it 100% return? Is it a 200% return? We don't know. Apple has a forward P of 25. Baidu is 10, which is just a little bit below Micron, which shows you how out of whack Baidu's forward PEs is, comparatively speaking. Not ExxonMobil. Oracle has a price of 4P of 16.78, 28.82. Oracle is probably the closest one that we would get to Micron's earnings. As we looked at Micron, we didn't want to give them too much of a buffer or too much of an expectation. We came up with a 17.5. And if we were to look at what Micron can offer us into the future, we see a price target of almost $115, which is in line on the high end of where the calls are for a $100 price target. If we change this to a 16, we're at 105. Micron is one of the ones we're looking forward to next year because of the opportunity of where we're going. We also like Square. And we like Square because of financials, because it also has no current PE. But if it's acting like a bank and doing what banks should do, and we look at our banks again for the future, where they could get to, if we looked at Visa with a forward P of 23.38, if we look at MasterCard with a PE of 29.32 in the future, PayPal only has an 18.2, currently 11.03. It's somewhere in that mix. If we put a 25 earnings potential, I should do a 28, give it a 28. If we came up with a 28 earnings potential on Square, that gives us a price of $86.24 on a stock currently trading at $69. Good jump up today, and 31 cents. This is how we come up with our numbers. This is how we do our valuations. And so our valuations are based on working the numbers. I will continue to work these numbers and have them available for you. I'll probably have them as an attachment next week, but I also will save this and get it attached to this current, which I guess I could do right now, huh? I'll get this saved and I will attach it right now for those of you who are interested to be able to basically take it and use it yourself. And then you can work your own numbers and see how close you've been to getting it. So if you go to your handout section, you should be able to download that same spreadsheet. And that way you'll have access to it and you'll see where we're at. Okay, looking into this next year. Positives. Rate hikes. Just kidding. Rate cuts. How many are we getting? 2 or 3? Or none? Or 1? What are we doing for rate hikes? Our rate meeting is on the 31st of January. We had one chair today. What did she basically tell us? She said, Fed Governor Bowman, hikes likely over, but not ready to cut. This is Federal Reserve Governor Michelle Bowman. Rate hikes are done, but we're not ready to cut. How many rate hikes do we get this year, folks? Give me a number. How many rate hikes do we get? I'm going with 2 as well. We were thinking we were going to get 1 whole percentage point. But if you look at when the meetings occur, we don't have that option. They don't want it to affect an election. Technically, they're not supposed to, right? So the rate hikes probably are looking at 2. And it's 2 quarter point cuts. Not so excited to see them in March. Anyone disagree? Anyone think I'm losing it? I should probably put it in here, CNBC. She was so negative. Why do I not find her? There she is. I'm going to put this in for you guys to see. You're a quiet group today, huh? No one's willing to take a guess. Come on, guys. Some of you guys have had the education. Kind of gets tough, huh? Have to decide what we really believe it's going to be. But after hearing her talk today, it was pretty simple to say, yeah, you know what? There's no way we're getting to 1% or 1.5%. All of her explanations made perfect sense. And it was, yeah, I mean, it just, I don't see it. I just don't see it. If I went and I took the briefing, will the Fed fight the market? Actions speak louder than words, rate cuts. I just found it very interesting. The Fed could cut rates 6 times in 2024. That isn't the Fed's baseline forecast, which goes to show there's a wide range of variability for a self-described data-dependent Fed. No way we're going to get 6 rate hikes. We're not there. There's no way we're going to get 1.5%. We're not there. But anyone know where the mortgage rate dropped to today? And the borrowing rate? 4%, right? Mortgage rates have started to tumble down. Mod 6, prime plus 2 could get you to 6. But as I was looking today, the 10-year Treasury finished at 4.021. And the 10 years typically where they've come up with the interest rates for the mortgages. All right, no earnings date set up. What will the markets end the week? I'm going to go with higher. Because of last week, our charts are giving us a little bit of room. On the Dow, we're just touching overbought again. On the S&P 500, we have a little bit of room to go higher. And even with the huge up day in the NASDAQ today, we've got a lot of room to go higher on the NASDAQ. Another 300 points. Technically, our pullback last week was helpful. Where are we going to finish January? I'm going to go with 3%. Not a whole lot of earnings to worry about except for Bank of America and JP Morgan on Friday. This is the first week of banks: BlackRock, Citi, Delta Airlines, United Healthcare, Bank of America, JP Morgan. That's coming up. That's a little bit of what we're looking at. Economic reports, a pretty quiet week. CPI and PPI numbers towards the end of the week that should still be good. How am I looking to trade? We are preparing for earnings and may run current long put protection. Protection out of the money. I don't think we want to change or roll right now. We're looking at holding it out of the money. So Bank of America is trading at 34. We have protection at 33. We will most likely keep that protection $1 out of the money, expecting Bank of America to do pretty well with the rise in our rise in our stock market and their trading for the last quarter of last year. All right. Interesting on Micron. I just gave you guys a couple things so you can see what we're seeing on how we're excited. I just want you to know, not a big fan of finance.yahoo or Zacks. Our proven model, so it's a proven model, does not concisely predict an earnings beat for Micron this season. Yet they did. So their proven model doesn't prove much of anything. It's a best educated guess. Please don't spend money on yahoo.finance or on Zacks. Their proven model does not conclusively predict anything. So don't spend your money on it. For whatever reason, some people get a little frustrated with me. I guess some people feel like all I do is rip on other people that are in my industry. All I'm trying to show are facts. And if those facts are ripping or speaking poorly of someone else, please don't blame me for that. It's their own statement. Our proven model does not conclusively predict jack squat. It's proven, but it doesn't conclusively predict anything. Please don't get mad at me. Please don't think I'm being mean to other people, because I'm pointing out their facts that kind of make them look like an idiot. My opinion, I'm not trying to be mean to anyone. I'm just showing you in their own writing what they're saying. With that said, I'm just going to giggle on one last one. Anyone here a Susie Orman fan? Anyone? No one's willing to say anything. Have I offended everyone here tonight? If I did, I apologize, kind of. Susie Orman. One more time, just again, it's in her own numbers, which I scratch my head and I'm thinking, what are you doing? To illustrate the power of compound interest. Here is what she's telling you. If a 25-year-old puts $100 into the S&P 500 index fund through a Roth IRA every month until they're 65, assuming an annual compounding interest rate of 12%, the person would retire with roughly $1.2 million in retirement savings. And CNBC agrees with them. So let me just point a couple facts out, period. At any time in the life of the stock market, has it every single year given you back 12%? Because the historical annual interest rate is 7.75, and that is counting dividends. So the historical rate is 7.75, counting 1.79% average dividends for the time period from 1950. And the average is 7.75, counting the dividend. So all of a sudden, we're going to get a 12%. Every year, the market's going to give you a 12%, and you're going to put in $100 every month for 40 years. There's never a down year where you lose, 48% like in 2008, have to get 100% back, just to get to back even. I don't understand why CNBC and Orman would even give you this information or publish it, acting like the stock market is a savings account, attaching 4.25% higher average rate of return than the market's been giving, and telling people that's what they should do. The numbers don't add up. They don't come anywhere close. Yet this is what was published on Friday. I am sorry if I piss some of you off and you think that I hate everyone else. To a certain degree, I'm politely going to say, I don't care. The facts are the facts. And until you lose $250,000 or until you lose a Corvette because a 27% published mutual fund return really only gives you 13%, that's who I am. And I'm going to keep giving you those facts so that you guys can make your best educated decision. I've had some really good returns, and we're on the cusp of having a lot of things hopefully come back. And all of my numbers, and I'm going to thank Rich again, all of my numbers usually come to pass, but I just don't give you a time frame. Historically, I can double portfolios, especially if they're starting at $500,000 or more. Happens in a 4.5 to 5.5 year period of time. It actually was happening for a while in a 4-year period of time. But my numbers change as the market changes. All I'm going to tell you is I give you the opportunity to have some ridiculous returns some years by making up some downward movement and dollar cost averaging for you without having to put more money into your account. I love what I get to do for you guys, and I hope these little lessons as we go through them will be helpful for you to truly understand what your money is doing and why. Are there any questions anyone has for me tonight? I'm going a little bit longer than usual. Are there any questions you guys have for me tonight? I'm going to keep going through these little lessons. Tonight was valuations. I might even do a valuations part 2 as we work through a couple other numbers, and I give you some ideas on how I'm coming up with these numbers, which are nothing more than comparing them and looking at opportunities into the future and risks into the future. But I do want us to create these little 10, 15, I guess apparently 20-minute videos where I'm going to have my typical commentary, but then I'm going to call it a lesson video. And today was valuations, the Warren Buffett style. I'm going to cut these out and do them into littler, smaller videos so you can have access to them and don't have to wade through all the other stuff that I've had in here. Any other questions you guys have that I can finish for you tonight? Thank you, Maud. I appreciate it. I'm not going to read a couple of those comments, but thank you. All right, if I see no more questions coming through, guys, I appreciate with you being here with me tonight. I do hope this is helpful for you. On my YouTube channel, I'm going to have, it's going to take me a couple days. I'm going to work with Dave. We're going to cut these little segments out so I can put 44 lessons for you. And they're just stock market lessons like valuations and how to calculate valuations. Don't forget, you can go to the handouts and you should be able to click and download the valuation chart where I have it right now. It's unprotected, so you guys can put your own numbers in there, but don't hesitate to go to the handouts, and you should be able to download the 2024 stock valuation projections. Someone made the comment, hey, what if you put in there earnings dates? You can do whatever you want with it. I'm just trying to give myself a baseline for 2024. So I'm going to complete this, and this will be my baseline for 2024 on what I like and why. I've actually done this for hundreds of stocks. We only have like 57 here. I've done hundreds of stocks over my vacation on fundamental analysis and projections like this. So hopefully this is something that you guys can play with. Bill, glad it works. Thank you very much. Anyone else, just go to the handout section and you can download this Excel spreadsheet, or if you were to email me at khurley@hurleyinvestments.com, again, khurley@hurleyinvestments.com. You could do info@hurleyinvestments.com. It'll still come to us, and we can get this emailed off to you. Guys, appreciate you being here tonight. Thank you very much. Sorry it took a full hour, but I do look forward to seeing you next week. And with that said, have a good evening, and I will see you next Monday. Bye-bye.